For generations, the Singaporean dream has been tied to owning a home. Our government, the People's Action Party, has consistently promised us that the HDB flat will not just be a roof over our heads, but a valuable nest egg for retirement. But what if I told you that in today's economic climate, that promise might not hold true? What if buying a home in Singapore is no longer the sound investment it once was, and is in fact largely an emotionally driven decision? Stay tuned, because I'm going to break down exactly why buying a home in Singapore in 2025 might be a poor financial investment. I'm not here to debate the past. Whether it was a good investment decades ago should not be your concern. What I can tell you now with absolute certainty is that in 2025, buying a home in Singapore is a poor investment. The numbers simply don't add up. First things first, let me educate you a bit about HDB Housing Development Board. As of now, for a bank loan, the minimum down payment for HDB is 25% of the home price, with at least 5% of house price paid in cash and remainder paid with savings from CPF ordinary account. So what is CPF? Basically, an individualized safety net, as it's mentioned by government, where employer contributes 20% of his salary and employer contributes additional 17% with some cap. I'll need to make several assumptions to help you visualize the buying of home in Singapore more clearly. Currently, the HDB annual interest rate is 2.6%. I assume most couples would try to go for a 5-room flat, so everyone has their own room and it's bigger. Such a house would probably cost on average $600,000. I'll also assume that couple would pay an average of $2,400 every month for the housing loan plan. Using a loan calculator, a 20-year bank loan would mean paying additional $126,000 in interest. Making multiple assumptions, I will also need to factor in buyer's stamp duty of 12.6k, which is an additional 2% of housing price. And for your info, there's also like ABSD, which is basically a tax created to reduce incentive to flip houses. I'll fetch the table for you. When COVID-19 hit, PAP announced multiple temporary cooling measures, as you can see, are permanent. There's also property tax. To calculate property tax, I'll assume the median monthly rental of 3.6k and calculate. As you can see, the annual property tax is about 1.3k. I'm ignoring the rebate as that is based on the government's whims and can't be expected for every year. 20 years would be 26k. Additionally, the monthly maintenance fee would be about 1,000 a year, so about 20k for 20 years. And also the maintenance of household appliances, which I would baseline at $100 every year, which is 2,000 for 20 years. And in total, the cost of the house would be about 786.6k, and I haven't even factored in the renovation costs. And based off an annual return of 5.66% for 20 years, the house would be 1.8 million in 20 years. And this is a generous estimate considering housing prices are starting to stagnate over the past decade. Then the annual return after accounting for 2% selling fee for property agent would be 4.17%. I count for selling fee as you can't possibly hold a HDB forever since it's a 99-year lease, and the prices will start to drop sharply once the house has less than 50 years left. So what if you want to rent your house for passive income? I think it's something that most people are quite excited about, as buying a house means that you are able to rent it out to tenants and you get to earn money on top of that. First, you need to fulfill the minimum occupancy period of 5 years for standard, 10 years for plus and prime. The standard plus prime scheme was created by our government last year to better reflect their locational attributes. I won't go into detail, but if you want to know more, comment down below and I might just create a video explaining it. So I'll assume 5 years. House is consistently occupied. Since you have to pay 1 month of rental to property agent every year as part of the tax, you only get 11 months of rental every year. And assuming the median monthly rental of 3.6 thousand, that would mean 594,000 of passive income over 15 years. Evidently, there will be an increase in property tax annually by about 5.2k, which is the additional 77.9k for 15 years. On meeting the calculation, the 20-year annual return would be about 5.1%. And if you factor in that the real estate is currently more stagnant compared to the past, the actual returns before inflation will only be about 2-3%. And compare that to the S&P 500, which has an annualized return of 10.3%. Please like, subscribe, and comment down below if you enjoy my video. If you want more advice on how to invest in the S&P 500, please check out my previous video. Thank you.